Imagine discovering that the world's greatest investor has been quietly selling stocks for years. Not because he needs the money, not because he's retiring, and not because he suddenly stopped believing in businesses. Instead, he's been piling up cash. Hundreds of billions of dollars in cash. Today, Warren Buffett's company, Berkshire Hathaway, is sitting on nearly $400 billion in cash and short-term government bonds. That's more money than the entire economies of many countries. And here's the part that should make every investor pay attention. The last 2 times Buffett built a cash pile anywhere close to this size, the financial world was about to experience a major shock. First came the dot-com crash. Then came the 2008 financial crisis. Now he's doing it again. But before you assume Buffett is predicting another market collapse, there's a much bigger story hiding beneath the surface. Because this isn't just about what Buffett is selling, it's about what he's waiting to buy. And if history repeats itself, the move he's making today could shape the next decade of investment returns. So, why is the most successful investor of the modern era sitting on nearly $400 billion in cash? What does he see that others don't? And should ordinary investors be paying attention? Let's find out. The quiet exit. Nobody noticed. Most people imagine market crashes arriving with alarms and warning sirens. Reality is usually much quieter. The biggest signals often appear years before the headlines. And that's exactly what makes Buffett's current position so fascinating. Because Berkshire Hathaway didn't wake up one morning and suddenly decide to hoard cash. This process has been unfolding for years. At the end of 2023, Berkshire's cash and Treasury holdings stood at roughly $168 billion. That number alone was enormous. Yet instead of putting that money back into stocks, Buffett continued adding to the pile. By the end of 2024, Berkshire's cash position had doubled. A year later, it had climbed even higher. Today, it sits at nearly $400 billion. Think about that for a moment. This isn't a hedge fund manager making a short-term trade. This isn't a trader trying to time the market. This is Warren Buffett, a man who built his reputation by buying great businesses and holding them for decades. And yet, 1/3 of Berkshire Hathaway's assets are now sitting in cash and Treasury bills. Why? To answer that question, we need to look at where the money came from. Because Buffett didn't find $400 billion under a mattress. He created it by selling. And the stocks he chose to sell tell an important story. Selling the crown jewels. For years, Apple was Buffett's masterpiece. It became Berkshire Hathaway's largest stock position. At its peak, Apple represented an enormous share of the entire portfolio. Buffett repeatedly praised the company. He admired its brand. He admired its ecosystem. He admired its ability to generate cash. Yet over the last several years, Berkshire Hathaway quietly reduced its Apple position. Again, and again, and again. The same thing happened with Bank of America, another one of Berkshire's largest holdings. Another company Buffett had backed with conviction. Another position that was gradually trimmed. The key word here is gradually. Buffett wasn't panic selling. He wasn't running for the exits. Instead, he was methodically converting stocks into cash, quarter after quarter, year after year, almost like someone preparing for a future opportunity. And that's where most people misunderstand Buffett. Because he doesn't build cash because he's scared. He builds cash because he wants options. The ability to act when everyone else can't. The ability to buy when others are forced to sell. The ability to strike when prices finally become attractive. And that's exactly what happened before. Twice. To understand what Buffett might be preparing for today, we need to travel back to one of the most euphoric periods in market history, the late 1990s, a time when investors believed the rules of the investing had changed forever, a time when Warren Buffett looked completely wrong, at least temporarily. The day Buffett looked like a fool. To understand why investors are paying attention to Buffett's cash pile today, you need to understand what happened in 1999, because at the time, Buffett looked completely wrong. The late 1990s were unlike anything investors had ever seen. The internet was changing the world. New technology companies were appearing every week. Stock prices seemed to rise no matter what. People quit their jobs to trade full-time. College students became millionaires. Taxi drivers were giving stock tips. And many investors genuinely believed a new era had arrived. An era where profits didn't matter. An era where valuation didn't matter. An era where stocks could only go higher. Sound familiar? While everyone else was rushing into technology stocks, Buffett was doing something very different. Nothing. He refused to participate. He refused to chase prices. He refused to buy companies he couldn't understand. And Wall Street hated him for it. Financial magazines questioned whether he had lost his touch. Analysts claimed he was outdated. Commentators said the world had moved on. For years, Buffett had been considered the smartest investor alive. Suddenly, many people were calling him a dinosaur, and honestly, for a while, it looked like they were right. Technology stocks kept climbing. The Nasdaq exploded higher. Investors who ignored Buffett became rich. Investors who followed him looked foolish. But Buffett wasn't looking at stock prices. He was looking at something else: valuations. And what he saw terrified him. The total value of the stock market had reached unprecedented levels compared to the size of the economy. Companies with little revenue were worth billions. Businesses with no profits were attracting massive investments. The market wasn't pricing reality anymore. It was pricing dreams. Buffett later described conditions like these with a simple phrase: playing with fire. And then the fire started. In March 2000, the bubble burst. At first, investors weren't worried. Every dip had recovered before. This one would too. Except it didn't. Weeks became months. Months became years. The Nasdaq eventually collapsed nearly 80%. Trillions of dollars vanished. Thousands of companies disappeared. Fortunes evaporated. People who believed they were financial geniuses discovered they had simply been riding a bubble. And Warren Buffett, the man everyone mocked, he survived almost untouched. Not because he predicted the exact day of the crash, not because he possessed some magical forecasting ability, but because he refused to overpay when everyone else lost discipline. The lesson wasn't that Buffett could see the future. The lesson was that he understood human nature. And human nature never changes. But the dot-com crash wasn't the only time Buffett built a fortress of cash before disaster struck. The second example would be even more dramatic, because this time the entire financial system was at risk. The crisis nobody wanted to believe. If the dot-com bubble was driven by greed, the 2008 financial crisis was driven by debt. And once again, Buffett saw danger long before most people. During the early 2000s, America was obsessed with housing. House prices climbed year after year. Banks issued mortgages to almost anyone. Investors believed real estate could never fall nationwide. The logic sounded convincing. Home prices had risen for decades. Why would they stop now? Financial institutions built increasingly complex products around mortgages. Banks borrowed more. Investors borrowed more. Everyone was making money, at least on paper. And just like before, Buffett wasn't impressed. In his shareholder letters, he repeatedly warned about excessive risk. He famously described certain financial derivatives as financial weapons of mass destruction. Many people laughed. The economy was booming. Stocks were rising. Real estate was soaring. Why listen to the old guy? But Buffett wasn't focused on today's profits. He was focused on tomorrow's risks. And slowly, he began accumulating cash. Again, not because he knew exactly when problems would appear, but because he understood what happens when leverage becomes excessive. Eventually, the cracks started to show. Mortgage defaults increased, housing prices stalled, banks became nervous, then panic arrived. Suddenly, institutions that looked invincible were fighting for survival. Lehman Brothers collapsed, credit markets froze, investors scrambled for liquidity, and this is where Buffett's cash became a weapon. Because while everyone else was desperate, Buffett had options. Lots of them. He invested billions into Goldman Sachs, billions into General Electric, billions into Bank of America. But these weren't ordinary investments. They came with extraordinary terms. High yields, special privileges, massive upside potential. Why? Because Buffett was one of the few people on earth with cash when cash mattered most. The same investors who mocked him during the boom suddenly needed him during the crisis. And once again, Buffett turned patience into billions. Which brings us back to today, because once again, Buffett is sitting on a mountain of cash. Once again, markets are near record highs. And once again, investors are asking the same question. What exactly is he seeing? Why today's market is flashing warning signs? The most important question isn't whether Buffett is bearish. The important question is why. Because Buffett doesn't wake up in the morning trying to predict recessions. He doesn't spend his time forecasting economic disasters. He focuses on something much simpler: price. More specifically, whether the price investors are paying today makes sense relative to the future returns they are likely to receive. And right now, the numbers are making Buffett uncomfortable. One of Buffett's favorite valuation measures compares the total value of the stock market to the size of the economy. For decades, this indicator has served as a rough way of measuring whether investors are becoming overly optimistic. Today, it sits near the highest level ever recorded. Higher than before the dot-com crash, higher than most periods in modern market history. That doesn't guarantee a crash, but it does suggest expectations have become extremely ambitious. And nowhere is that optimism more visible than in technology. Artificial intelligence has become the market's newest obsession. Every company wants to be an AI company. Every earnings call mentions AI. Every investor wants exposure to AI. And while the technology itself is undeniably powerful, history teaches us something important. Great technology and great investments are not always the same thing. The internet changed the world. Yet countless internet stocks still collapsed. Railroads changed transportation. Many railroad investors still lost money. Electricity transformed civilization. Many electricity companies still failed. The lesson? A revolutionary technology can be real while the investment hype surrounding it becomes completely detached from reality. That's what Buffett understands better than almost anyone. He isn't betting against innovation. He's questioning the prices investors are willing to pay for it. And when prices rise faster than fundamentals, history usually doesn't end well. Which brings us to Apple. Because many people believe Buffett sold Apple because he stopped liking the company. That's probably not true. Apple remains one of the greatest businesses ever created. Its products dominate markets, its customers are loyal, its profits are enormous. The business itself wasn't the problem. The valuation was. Over time, Apple's stock price rose much faster than the underlying business. Eventually, investors were paying dramatically more for every dollar of earnings than Buffett originally paid. And when valuations expand far beyond fundamentals, disciplined investors often take profits. Not because the company is bad, because the price is too good. That's exactly what Buffett appears to have done. The same discipline that made him rich is the same discipline causing him to sell. But here's where things become really interesting, because unlike previous decades, Buffett no longer needs a crash to justify holding cash. And that's changing the entire equation. The secret most investors are missing. For years, critics attacked Buffett whenever he held too much cash. And honestly, they had a point. In a world where interest rates were near zero, cash was expensive to own. Every dollar sitting in cash was a dollar not invested. A dollar not compounding, a dollar falling behind inflation. Holding massive amounts of cash carried a huge opportunity cost. But today is different, very different. For the first time in many years, cash actually pays investors. Short-term treasury bills are generating meaningful yields. Government bonds are producing real income. And for Berkshire Hathaway, that changes everything. Imagine earning billions of dollars every year simply by waiting. No factories, no employees, no product launches, no risk-taking, just patience. That's exactly what's happening. Berkshire's enormous treasury portfolio is producing roughly $12 to $13 billion annually. Think about that for a second. Many Fortune 500 companies don't generate that much profit, yet Buffett is earning it while sitting on the sidelines. This creates an incredible advantage. He no longer needs to rush. He no longer needs to force investment. He no longer needs to compromise his standards. He can simply wait. And every day he waits, more cash arrives. This is why so many investors misunderstand the situation. They think Buffett is predicting disaster, but Buffett may simply be comparing opportunities. If stocks offer mediocre future returns while treasury bills offer attractive yields, the decision becomes surprisingly simple. Why take unnecessary risk? Why chase overpriced assets? Why force investments that don't meet your standards? Instead, Buffett is doing what he's always done, waiting for the odds to shift in his favor. And if history is any guide, he believes those odds will eventually improve. The only question is when. Because when that moment arrives, Buffett won't be thinking about defense anymore. He'll be thinking about offense. And that's where his $397 billion becomes truly terrifying. The $397 billion weapon. Most people look at Buffett's cash pile and see caution. Buffett sees opportunity. The difference is enormous because cash isn't valuable during good times. Cash becomes valuable during bad times. When markets are rising, everyone feels smart. Money is abundant. Credit is easy. Investors are confident. Opportunities are scarce. But during crises, everything reverses. Fear replaces confidence. Liquidity disappears. Prices collapse. And suddenly, incredible businesses become available at extraordinary discounts. That's where Buffett thrives. We've seen it before. During the financial crisis, companies that seemed untouchable suddenly needed help. Banks needed capital, corporations needed financing, entire industries needed liquidity. And Buffett stepped in, not as a victim, as a buyer. The terms he negotiated were extraordinary. Why? Because when everyone needs cash and only a handful of people have it, the people with cash make the rules. Now imagine that situation today. Except instead of tens of billions, Buffett controls nearly $400 billion. That amount of capital can reshape entire industries. It can acquire major companies. It can fund massive rescue deals. It can take advantage of opportunities most investors can only dream about. And that's the real significance of Berkshire's cash pile. It's not merely a defensive position. It's a giant call option on future chaos. The more panic spreads, the more valuable Buffett's position becomes. And history suggests he knows it. Because Buffett has spent decades preparing for moments when everyone else loses their heads. The question isn't whether opportunities will appear. History guarantees they will. The question is who will be prepared when they arrive. And right now, no one appears more prepared than Warren Buffett, which leads to the most important lesson in this entire story. The final takeaway. So is Warren Buffett predicting a market crash? Honestly, nobody knows. Maybe he's early, maybe he's wrong. Maybe markets continue climbing for years. That's entirely possible. But focusing on whether Buffett can predict the future misses the bigger point. Because Buffett's greatest skill has never been forecasting. It's discipline. While most investors become greedy during booms, Buffett remains patient. While others chase excitement, Buffett waits for value. While crowds focus on what they might gain today, Buffett focuses on what they might lose tomorrow. And that mindset has built one of the greatest investment records in history. The real message behind Berkshire's $397 billion cash pile isn't sell everything. It's something much more important. Prepare, build flexibility, avoid overpaying, keep liquidity available, and remember that opportunities often arrive disguised as disasters. The investors who become wealthy during the next decade may not be the ones taking the most risk today. They may be the ones preserving the ability to act tomorrow, because every major market cycle creates winners and losers. The winners are rarely the people who predicted the future perfectly. They're usually the people who stayed disciplined when everyone else became emotional. That's the lesson Buffett has taught for more than half a century. And today, with nearly $400 billion waiting on the sidelines, he appears to be teaching it once again. The question is, are investors paying attention? Because if history repeats itself, the answer to that question could become very expensive. Thank you so much for watching. If you enjoyed this breakdown, let us know your thoughts in the comments below. Do you think Buffett is preparing for a major market correction? Or do you think he's missing another historic bull run? I'd genuinely love to hear your perspective. And as always, thank you for watching. I'll see you in the next one.